Earl took out a mortgage on his home for $250,000 in year 1. He filed a single for year 1. In April year 1, when the home had a fair market value of $430,000, Earl took out a home equity loan for $140,000. He used the proceeds as follows: $90,000 for home improvements, $30,000 for payment of credit card debt, $20,000 for purchase of securities that produce tax-free income. How much of the $140,000 loan would produce deductible mortgage interest in year 1? So the question is specifically asking about the interest that Earl has to pay on the loan, right? You take out a loan, you have to pay interest. How much of that can be deductible? How much can produce deductible mortgage interest? So if you look at the actual amounts, $90,000 home improvements, $30,000 payment of credit card debt, $20,000 purchase of securities. The first two items deal with personal items. The third item is an investment item, purchase of securities that produce tax-free income. So let's talk about personal items first. The general rule is that no personal interest may be deducted. So we're talking about things like credit card debt, medical expenses, car loans, those kinds of things. There is one exception though, and that applies to qualified residence interest. Okay? So it can be on acquisition indebtedness or it can be on home equity indebtedness. But if it's home equity indebtedness, it has to relate to the actual house. You're buying a house, you're improving a house, you're bettering the house. It can't be related to things not related to the house. So here we have a home equity loan. Okay, the home equity loan. And we have to look at what exactly the proceeds are used for. So the $90,000 for the home improvements, that portion is good because it's used to better the home. But the $30,000 for the payment of credit card debt, that portion, not good because it doesn't better the home. So we can't consider the $30,000. The $20,000 of the home equity loan is used for purchase of securities. That amount can't also be used because it doesn't relate to improving the home. Another reason why this one's not allowed is because there's a special rule in income tax that says you can't take deductions on tax-exempt items. So if something produces tax-exempt income, which we have here, so these securities, let's say they create municipal bond interest. You can't take the deduction of interest related to taking a loan out to acquire those specific municipal bond securities. You're not allowed to do that. So whether you're looking at it from the home equity argument or from the tax-exempt argument, you're not allowed to take the interest on that loan. That's very important to understand. Okay? So it looks like the only portion we're allowed to take is the $90,000 for home improvements, because again, the rule is you can take the deduction of the interest on qualified residence, the mortgage, as long as the acquisition indebtedness or the home equity indebtedness relates to the actual house or improving the house or bettering the house. One other note is that you're only allowed to take interest on mortgages up to $750,000 or $1 million, depending on when the mortgage was taken out. So here, Earl takes out a $250,000 mortgage, but also takes out $140,000. Well, these two numbers together, which is $390, is well below $750,000, so that's not an issue here. So of the $140,000 loan, only the $90,000 portion can produce deductible interest. So the correct answer here is B, $90,000.